Hello, my awesome accounting students. Welcome back for the second part of Chapter 12. In the first part of this video, we are reviewing why adjusting journal entries are needed. We talked about several. Briefly, we talked about, first of all, the matching process reminds us that our goal is to record revenues and the related expenses in the same period. So in the last video, we talked about an inventory adjustment, a loss on uncollectibles. We talked about three types of deferred expenses, which we had reviewed in previous chapters. These would be the journal entries for supplies, for the prepaids, and for depreciation. In addition, we went over the adjustment for accrued payroll and the related taxes that go with it. In this video, we'll cover the remaining adjustments needed. These will deal with accrued interest. Sometimes it'll be interest expense if we're the ones that owe the money, or it could be interest revenue if we are the ones that are owed the money. We'll cover the unearned adjustment, and then we'll bring back the concept of the 10-column worksheet and work through some examples. Let's get started. Because GAAP says we need to record expenses when incurred and not necessarily when paid, anytime we have debt on the books, this may lead to accrued interest. That means as of the end of the fiscal year, in this case 12/31, we need to accrue any interest that is owed. In this example, on December 1st, the company issued a 2-month note for $2,000 with annual interest of 12%. The note was recorded in the notes payable account. They will pay the interest when the note matures 2 months later on February 1st. However, interest expense needs to be recorded in the period that the interest benefited. The accrued interest is determined by using the interest formula, principal times rate times time. In this case, we would take the $2,000 of principal, multiply by the annual 12% or 0.12, and multiply by the time. The time factor is where students have trouble. T for the time formula is the time that has elapsed between the date the note was signed and the end of the fiscal year. In this case, since the note was signed on December 1st and the end of the year is December 31st, there is 1 month or 1/12 of a year's worth of interest that needs to be accrued. The journal entry to do this is a debit to interest expense and a credit to interest payable. The flip side can also be appropriate. If we were owed interest on a similar note, we would record the interest that is due to us. So if we had a note receivable on our books, we would compute interest exactly the same way, except this time we would debit interest receivable for $20 and credit interest revenue of $20. So once again, interest can go either way. Most of us as students relate to the first accrual of interest expense on debt that we owe. On the flip side, however, if we are owed money by somebody else, it would be appropriate to accrue the interest revenue. The last adjustment that your author touches is for unearned income, or another name for it is deferred revenue. Unearned income or deferred revenue exists when cash is received before the income is earned. Under the accrual basis of accounting, only income that has been earned appears on the income statement. What the author doesn't do too good of a job explaining is that the unearned revenue account is the flip side of a prepaid. We talked about this in class. For example, if I pay ahead of time for attorney services and I give my attorney a retainer, I would have a debit to a prepaid legal fees on my book. But when the attorney receives the money ahead of when any work is performed, he would have an unearned or deferred revenue on his books. The unearned account is a liability account. This often throws students because of the lack of the word payable in the account name. Read more about this in your textbook, and of course we will practice this in class. I hate to be the bearer of bad news, but that 10-column worksheet's coming back with a vengeance this time. The mechanics are still the same, but you'll notice that there's a lot more accounts on it. The reason there's a lot more accounts is we've learned a lot since Chapter 5. Let's review what that worksheet is good for. It is an internal tool used to pull together all the adjustment data and then to give a preview to the owner what his net income or loss is, and also a glance at the balance sheet. Just like we learned last time, it doesn't replace the financial statements. It simply is a look at a glance type of a tool so that the owner has a preview of what's ahead. Let's review it. The worksheet is so big that it's almost impossible to show it to you on a small video screen. So review the steps of the 10-column worksheet. They're exactly identical to what we used in Chapter 5. One thing I do want to pay particular attention to is the new income summary. We want to make sure that we bring over both the debit and the credit on the income summary line. The reason is both of these are needed in the next chapter when we learn how to do our multi-step income statement. So for right now, go check out the example in the book and get that highlighter pen and highlight that both the debit and the credit in the income summary line item must be brought over to the income statement. This will become very important in the next chapter. The last step demonstrated in this book is the creation of the financial statements. We'll see in Chapter 13 that the income statement grew. It's a monster income statement, technically called a multi-step or classified income statement. So that's just a little preview of what's ahead. It's hard to believe that we're almost done. We have the tail end of the accounting cycle to complete, and then we'll be finished with our course. This is Professor Johnson signing out.